Good morning, everybody.
Good morning.
How are you? Well, this is an awesome gathering. I'm a little intimidated by the table up here and all of you out there. And thanks to all the TA folks, our special folks who came, because they're special. Okay? Welcome to the latest in Tax Analyst series of discussions on key issues in tax policy and tax administration. Today's debate will examine the intersection between U.S. state tax rules and international tax rules. I'm Chris Bergen, the president of TaxAnalysts, which is the nonprofit publisher of Tax Notes Today, State Tax Notes International, and many other fine print and online products on federal, state, and international taxation. We are in, believe it or not, our 12th year of public discussions on tax policy. If you are new to our discussions, let me say it's great to have you here. Let me take just a moment to explain our process today. I will open things up with some brief remarks to introduce our topic. David Bernori, Deputy Publisher at TaxAnalysts, and I will then kick off the discussion by inviting our distinguished panel of speakers to answer questions addressing various aspects of our topic. After that, we will open up the discussion to all of you, and we encourage all of you to participate. Actually, we're going to try something new here today. If you have a question or a point, just raise your hand as we're discussing, and we will recognize you and let you in, including everybody at the table. I just ask you, because we've got a lot of information to cover today, that you try to keep your comments brief. We are streaming live video of this event on our website. That explains the camera in the back of the room, so I want to welcome our virtual audience as well. We've now added a Q&A feature on our site that will allow the online viewers to submit their questions throughout our discussion today, and we will be taking those questions up here at the table. For all media purposes, we are on the record. For that reason, when one of us recognizes you, please tell us who you are. It helps with the transcript. And for those of you in the audience, once we call on you, we will get a handheld mic to you very quickly. We are also live tweeting this event at #StateTaxLessons as we reach more people beyond this room through social media. We invite our online viewers to send us questions via Twitter. Just tweet at #StateTaxLessons. I believe there's spaces between the words on that. And we hope to hear from you. We also will post the webcast and a transcript of today's event by the end of this week on our website, TaxAnalysts.com. And following this event, I'm told we will send a brief survey to all of you who are registered for this for your feedback, and we will be giving away a $50 American Express gift card to one lucky respondent. Now, on to the subject at hand, the intersection between U.S. state tax rules and international tax rules. The current international tax system is facing some real challenges. While the system has been largely unchanged since the 1920s, there has been a lot of public outcry recently over the ability of multinational corporations to generate significant revenue, yet be subject to a low tax burden. International governments have been feeling the pressure to change existing rules and, in essence, fix the problem. This is what led to the much publicized project led by the OECD, which focuses on base erosion and profit shifting, also known as BEPS. But taking a step back, let's look at the current international tax system. It relies on a set of principles and treaties drafted by U.S. and large Western European countries during interwar years. Not surprisingly, then, it reflects the economic realities of that time and does not address what we consider important issues now. For example, when cross-border commerce is an exception to normal practice, there is little need for detailed rules addressing jurisdiction to tax, nexus, or double taxation. But times have changed. The OECD's BEPS project touches on a number of important international tax concepts, including jurisdiction to tax, how to allocate income among different tax jurisdictions, reporting and sharing of taxpayer information, how to address double taxation, and how to resolve disputes. Interestingly, though, each of these issues has been considered at the U.S. state tax level for nearly a century. In a special edition of state tax notes and tax notes international that you were all given today. If you didn't get it, I think we have plenty of copies. We attempt to use the knowledge that has been gleaned by U.S. states as a means of informing the international tax debate. And that is the subject of today's conference. I am pleased to be joined by three tremendous panelists. Peter Barnes, of counsel with Kaplan and Drysdale, Diane Smith, counsel with McDermott, Will, and Emery, and Joe Huddleston, executive director for the Multi-State Tax Commission. Thank you all for being here. We've also invited a number of esteemed people to join the speakers at this table, and while we expect they will participate in the discussion, as I said earlier, we encourage everyone in the audience to participate as well. So, Peter, could you start by addressing the general rules for determining what is taxable for international tax purposes and specifically what constitutes PE?
That's jumping straight into the fire. There's no doubt about it that on the international front, in general, state tax, nexus for tax is based on physical presence. And that's been a struggle for more than just the last couple of years. When e-commerce started to emerge in the late 1990s, the international world, uninformed by the states, spent a lot of time, 98 through the early 2000s, looking at whether e-commerce suddenly upended all of the rules on nexus for tax and concluded they didn't. But in general, in order to have nexus to tax in the international world, you need to have a physical presence, a fixed place for some period of time, in some cases, in other cases, a single day. That's being challenged as we go forward with things like cloud computing and remote monitoring and digital downloads. And the international world's worried about those issues. But the cornerstone has been and continues to be physical presence.
Joe, could you address the definition of nexus and the rules for determining what is taxable at the state level?
Certainly. I want to begin by saying that my initial caveat is always that while I'm here as the Executive Director of the Multi-State Tax Commission, my comments may or may not represent the opinions of our member states or the Multi-State Tax Commission. So having said that, let me talk a little bit about nexus. Much as Peter outlined, the nexus issues for state tax are long-standing in that certainly in the 1800s, physical presence was the standard by which everybody began the discussion of what created nexus to tax. In fact, in the early 1800s, the U.S. Supreme Court, addressing what criteria were necessary to create a jurisdictional authority to tax, looked at many of these requirements as early as 1819, looking at the question of physical presence and what causes a state or allows a state to have jurisdiction to tax. And basically they've broken out into two areas. Early on they looked at physical presence, as Peter said, in Europe. In other words, residency. If you were resident in a jurisdiction, it was largely thought that, and in fact enforced, that there was sufficient requirement for that jurisdiction to tax, based upon some of the concepts that we'll talk about later having to do with dual sovereignty. That is the separation between the federal government and the state governments, and federalism as we talk about that going forward. Certainly as we evolved into the 20th century, the views of what created nexus for corporate income tax purposes began to evolve in the United States. It began on the base of looking at activities of railroads and other multi-state corporations, and we began to understand that the overall activity was not necessarily tied to a physical presence. So this discussion began to take place and continued to evolve through the decades of the 20th century, so that where we are currently is that for corporate income tax, many of the states will recognize nexus based upon activities that take place within the jurisdiction, that where corporate entities purposefully avail themselves of a marketplace. Many states, in fact most states, will take the view today that creates physical presence. Now that has been hotly contested for the last 30 years, in fact, but as of today, the purposeful availment concepts of nexus in the corporate income tax area has been repeatedly affirmed at the state court levels, and the U.S. Supreme Court has not opined on that issue so far, but they have repeatedly declined to get into that area. So it's, while it appears to be a fairly straightforward mechanism of carrying on activities, obviously it's perhaps much deeper than it is broad.
I think you have a question, Chris, right over here.
Tara?
Yes.
Yeah, Kara Griffith with TaxAnalysts. Peter, for you, I'm curious as to whether services PE mimics at all the state economic nexus.
It clearly does. Let me back up just to make sure everybody's sort of on board. A number of countries, including fully developed countries, Canada, are starting to say, hold on, if you provide services here, even if you aren't physically here, that ought to generate a permanent establishment and give us nexus. And yes, it does. There's the same debate, exactly the same debate in the international world you have in the States, between the producer states and the market states, producer countries, market countries. And so, yes, the services PE is an effort to push the boundary and to say physical presence is not the only basis on which we're going to tax you. If you provide services in some fashion, in some way, at some level, then yes, you are subject to tax. There's one important issue to point out here. If you believe that income generally should be taxed once, always once, but only once, if we have more nexus, if we have more jurisdictions in which the income is going to be taxed, there probably is going to be a reduction in tax in some jurisdictions, the home jurisdiction or somebody. We need to remember that there's only one pie here. And what we're talking about, I think, is how to split that pie between producer markets and consumer markets, between countries, between states. And so as we expand the PE concept, if we go that route, we've got to recognize there's still only one pie here.
Well, you know what, let me ask Diane a question, and then and Joe and Peter may want to weigh in as well. So when you look at Nexus and you look at PE, what specifically are the differences when you look at international permanent establishment rules and state Nexus rules? But if you can explain what those differences might be.
Yeah, David, and everybody else feel free to jump in. And this is something I think that always comes as a surprise to people that are only operating in the international area when they suddenly discover that they may be subject to state corporate income tax. One of the primary things to realize is that because the state corporate income tax jurisdiction in many states does have this economic nexus component, meaning that you don't actually have to have a physical presence. Now, there's lots of companies that are challenging that. But to the extent that a state says that merely having economic presence in the state will subject a corporation to that state's corporate income tax. As we've just seen in the international area, that's not how the U.S., as the federal government, would subject a foreign entity to the U.S. Income tax. Thus, the result is that an entity can not have PE in the U.S. So, for example, they might have a treaty that says PE is not established merely by holding goods for sale in a certain state, but nevertheless, the state, because that foreign entity has goods actually there, they would have a physical presence and thus be subject to the state tax. That's really kind of the fundamental issue, is that you can have the no PE but still have state nexus. A couple other things to bring out that I think are interesting is that in the PE arena, there's much more control for the taxing jurisdictions. Because when you look at how it works in the US, we've got the Internal Revenue Code that says basically in the absence of a treaty, if an entity has income effectively connected with a trade or business in the US, then that income is subject to tax in the US. But then the treaties, which establish the permanent establishment concept, they pull back on that further. So they have additional exceptions within that are negotiated in the international arena. The states, bless their hearts, are usually in the jurisdictional aspect, they don't have as much control because they're subject to the overall U.S. Constitution, both the Due Process and the Commerce Clause. So the states have this limit that they can't ever exceed, and that they're kind of stuck with that. Now, the states also can pull back on what their jurisdiction is, and we see that when they've got their sort of doing business definitions in the statutes. Thus, in the same way that in the international arena, they may say, okay, if you're just storing goods in a jurisdiction, it doesn't create PE. Some states have, for policy reasons, said, for example, if you've got a fulfillment center, if you're using a fulfillment center in a state, that doesn't create, you're not doing business, and thus you're not subject to tax. But that's sort of different than the Commerce Clause nexus issue. And one of the things Joe mentioned that I'd like to talk a little bit about is this concept of purposeful availment. Because I think when you look at the state nexus issues, you've got both the Due Process and the Commerce Clause. The purposeful availment concept is clearly a due process clause. So it applies to any jurisdictional concept. So even in the international arena, we've seen several cases recently from the US Supreme Court that before, even outside of the tax area, before a foreign entity can be subject to any type of jurisdiction here, there has to be some type of purposeful availment. Thus, they could not even be subject to tax if there was not some type of purposeful availment of the market in the US. On the other hand, we've got the Commerce Clause, which does not put any type of pressure on the federal government, but does for the states. And that's where we get this different nexus concept, which is the substantial nexus concept.
Joe, do you agree with that assessment?
I think that's largely accurate. I think that it's important to understand that PE, permanent establishment rules in the EU, tend to be much more restrictive than what we see in the states. There's any number of ways that physical presence can be established in the U.S. that would not meet a PE standard in the EU. The emphasis there on the word permanent. There's all kinds of different types of nexus activity, as Diane pointed out, that can create nexus under physical presence standards in the states, which might not in the EU or in the OECD countries. So there is a substantial difference. And what I would encourage you, as we make these discussions, I think it's important to keep in mind that this is really almost not an apples to apples discussion. What's going on in the EU and in other places around the world is really fundamentally different than what's going on in the States.
Peter, do you agree with that?
I do. Let me respond to one point Diane made and then make one new point. She said something very important that I don't want people to miss. The international group is not unmindful of the kinds of standards that the states apply because, as Diane said, the basic Internal Revenue Code has a engaged in trade or business standard. The U.S. only has 60 treaties. So there are a lot of countries in the world where the engaged in trade or business standard applies. So the international groups, I think, are pretty sensitive to that. The second point I want to make, though, is nexus is important, and we ought to talk about it, and I'm not trying to cut that short. But in the international world, the fact that you may be taxable is usually not that big a deal. Fine, you have nexus. I have a PE, I have a presence. That's the way I do business. Now let's get to the meat of the issue, which is how much income is attributable to the PE. So yes, there are taxpayers who just have this visceral reaction of, I don't want to have any tax compliance obligation in country X. I don't want nexus there, whether it's a state or otherwise. But in general, I think people are sophisticated enough to say, fine, if I'm taxable, I'm taxable. Now let's get down to what matters. What's the income attributable?
Right. We have a question down
Well, we got one here
Oh,
first.
I'm sorry.
And
then
two.
right.
We're getting engagement, which is great.
I'm Lyman Stone from the Tax Foundation, and I had a question about this circumstance where a firm could not have PE in the U.S. but still establish physical presence in a state. And specifically, that would seem to me to kind of cause a treaty problem. And so I was wondering, is there a case where this has happened and it's been, I guess not litigated, but argued out in a fairly public fashion between nations? I have in my head a similar circumstance with where tax incentives in Washington came up in a WTO case between the US and the EU. Is there a similar circumstance where a firm had physical presence but not PE, and it was hashed out fairly publicly?
The answer, I think, is no, because it's so well understood. I understand that you look at it and you say, hold on, you don't have a federal obligation, but you do have a New York obligation. What's going on? But after that initial horror, the answer is that's absolutely the truth. The U.S. treaties do not cover the states. States are not covered taxes. That's crystal clear. That's uniform. Now, interestingly, and this is actually in one of the articles in here, interestingly, there are a half dozen U.S. treaties where our treaty partner has covered subnational taxes. So there's a little bit of an imbalance in that the U.S. company is protected in the foreign jurisdiction, the foreign company is not protected here. But the issue is well understood, even if people think it's foolish. So I don't think it's controversial, other than by foreign investors who say, what's up? I'm surprised by this. And the U.S. does not hide this fact. This is not something we put over on other jurisdictions. They know that our subnational taxes are not covered taxes for treaty purposes under the PE article.
Yeah, I think there's a couple of issues there, and one is that PE concepts, as we know them in the EU, really are not applicable here and would not be subject to litigation in this country. The other is there's been a couple of cases through the year, several cases in fact, looking at whether or not treaty obligations extend past the federal government to the states, and they've been litigated fairly uniformly and outlined in one of my favorite cases, ITEL versus Huddleston, and Barclays Bank.
And there has been a history, at least not in the PE nexus area, but in the worldwide combined area, where the U.S. government actually initially did try to get some treaty protections prohibiting states from imposing worldwide combination, and that got shut down at the federal level. So there is this history that you can look to see that it was not popular.
We have a question down here at the end of the table.
So my question was actually answered, but let me follow up on this line right here. So in terms of...
Can you state your name, please?
Yeah, it's Pete Lowe with Kaplan and Drysdale.
Right.
So in terms of enforcement, states actually identifying situations where inbound companies may not have a PE or may not have nexus for federal purposes, but they do for states. How effective are states at identifying those situations?
They're not very effective because for almost all corporate income tax structures, the state governments begin at federal taxable income. So much of the calculations that state governments do as they begin to try to apportion income based upon whatever their apportionment formula is relies on the federal figure. So it's very difficult for states to go above the line and look at the transaction basis of what that number is. And it's rare that states will do that, although at times they do, given information they receive from the federal government. On the end of that question, the implied follow to that is, well, assuming they are able to identify these numbers and they issue an assessment, can they in fact enforce that assessment? As a general rule, they can, because almost nobody does business internationally in a vacuum. They have all manner of transactional types of relationships with the U.S. and with the states that enable the states to be able to enforce an assessment.
And Joe, you probably know more about this than I do, but there's the super secret, and I think we're getting into this later, information exchange that happens between the IRS and the states. When we're talking about PE at the federal level, because it's primarily more of a tax-based issue than a jurisdiction issue, there's a specific tax form that companies that say we don't have a PE, but we want to just file a protective form so the statute starts, they can file that at the federal level. I know that there's at least a couple states that do get that information that they can follow up on, because if it's being filed at the federal level, there's a possibility that they'll have physical presence. I don't know how widespread that is.
It's not very widespread.
And we're going to follow, we have a follow-up question later to address that issue, Diane, for the panel. Doug?
This is a little bit of a follow-up question as well. Doug Lindholm with Cost. I want to explore further Diane's comment about worldwide unitary, and then Peter's comment overlays the fact that states are not subject to international treaties, and it begs the question of whether they ought to be subject to international treaties. Does the fact that they are not subject to international treaties impede our nation's ability to speak with one voice? And this issue, as Diane mentioned, first arose in the worldwide combined arena back with the Barclays case in the early 90s, when California tried to impose mandatory worldwide combined reporting, and our foreign trading partners objected vociferously to the extent that the UK threatened retaliatory taxation, something that was completely out of the hands of our federal government. It was really the federal government was forced to step in and sort of mediate a dispute between trading partners in the states. I don't think that was in the best interests of our ability to speak with one voice. And that same issue is coming up again as states try to put statutory definitions of what a foreign tax haven is. And I can't think of why a tax commissioner would be qualified to make that determination, given the political implications of calling one of our trading partners a tax haven. And I wonder if you guys would like to comment further on that.
Doug, by the way, we have a couple of former tax commissioners.
I know.
Peter?
I'm happy to speak. Look, I cut my teeth as an international tax professional in 82, 83 on the Barclays case, which was the intersection of the international and the state stuff. Sure, I would love it if the states were bound by the treaties. That's great. But in the real world that we live in, let's get past that. There are plenty of other issues that irritate our trading partners in the tax arena a lot more than this one. They don't like it, but they don't like a lot of things we do. They don't like FATCA. They don't like a lot of stuff we're doing. So it seems to me, in terms of just my emotional energy, let's focus on things that we might actually impact. This issue, in my mind, is settled. And in a perfect world, sure, we would speak with one voice. The states would all use the same formula for allocating income. There would be no harmful competition between the states. I mean, I got a lot of items on my wish list. This one's low.
I'm sorry, go ahead, Joe.
Yeah, let me just comment on that. The issue of tax havens is not one which is exclusive to the United States. This is an issue which plagues the rest of the world as much as it does here. And as to whether or not tax commissioners in individual states have the capacity to be able to identify a tax haven or make those required judgments, let me just suggest to you that the tax haven problem worldwide is a whole lot like pornography. We all know it when we see it, so we don't need to kid ourselves about that.
Well, in the international arena, Tax Notes International will run an article at least every 3 months in which a foreign party says, why is the U.S. doing this? Because Delaware and Nevada are the worst tax havens in the whole wide world. So, I mean, I do a quick search over the last 10 years. That's been a piece in Tax Notes International all the time. So we live in a glass house in this regard. I can argue why Delaware and Nevada are different from Caymans. I get all that. But I just don't think we're in a very secure position.
One more question before we move on to the next topic. Joanne?
Sure. My name is Joanne Weiner. I'm with GW, and I also write for the Washington Post. But I used to write for TaxAnalysts, which was a great job. I was at the Treasury Department in the 1990s when this Barclays Bank case came to the Supreme Court. And I'm an economist, but it's the only Supreme Court brief I've worked on. And I just thought there's a couple things to clarify. One, Treasury did not tell the states what they had to do. We worked very carefully with all the parties involved to get to a voluntary agreement. Now, it's clear there was a lot of disagreement about mandatory worldwide combination. The states backed away voluntarily from it. The reason that state taxes are not covered by tax treaties, and I've negotiated a lot of tax treaties, is because they don't sit at the table. No one here would want to have someone else negotiate on their behalf and not have the ability to put a word in for them. So while it may be nice to talk about getting the states bound by U.S. international treaties, it's just not going to happen unless you put them all at the table. Now, the Multi-State Tax Commission has done a great job with protecting states' interests, and it's not just in tax treaties, but it's also in that border agreement with Mexico. It's also in the World Trade Organization. So anyway, that's just to clarify some of the stuff that went on, is that the Senate did reject the U.S.-UK treaty because it bound the states, and it was only approved after that provision was taken out. Anyway, thanks.
I want to turn to a topic now that all of our panelists have alluded to, and that is, how is the tax base allocated among the taxing jurisdictions? Many of you know that at the state level, this is done through formulary apportionment. At the international level, we use what is known as the arm's length standard. And that has led to some suggestions that formulary apportionment may be a good thing for the international arena. And I was hoping Joe might lead our discussion on formulary apportionment and maybe give a quick primer on how it works, and maybe address the MTC's role in promoting uniform apportionment formulas.
Well, to be brief about this, which is virtually impossible, but I'll make an effort here. Formulary apportionment begins with the concept that if it is that businesses do businesses in jurisdictions, that some percentage, some portion of their income that's generated from various factors in that jurisdiction should be taxable in that jurisdiction. So the original standing, of course, is that you begin with the overall concept that 100% minus whatever statutory deductions are available should be taxed in the jurisdictions in which businesses do business. So that apportionment methodology then begins, at least in most states, beginning several decades ago, with the concept of a three-factor apportionment formula: payroll, property, and sales in your jurisdiction versus payroll, property, and sales everywhere else. And that characterization would fairly apportion income for a tax base in each jurisdiction impacted. Now, clearly, that's not something which has been able to maintain itself over time. While states moved to a three-factor apportionment formula and discussed that and utilized it for a number of years, they began to move away from that for a variety of reasons, so that today we have only a handful of states that actually use an effective three-factor formula for apportioning corporate income. Today we see states moving toward adding weight to the sales factor, or going all the way to the end of that spectrum of using a single factor of sales only in a jurisdiction to apportion income into various jurisdictions. California, for instance, a very large state, is in a single sales factor concept now, which basically says business activity carried on in your state is going to be measured by your sales in the state, not by payroll or property located in California. And a number of states continue to move in that direction. So as we look at apportionment concepts, we see states moving toward a more uniform concept of apportionment, but that uniform concept is a single sales factor. That clearly is not the direction that the MTC has supported and proposed and has worked on over the years. We've looked at a three-factor apportionment formula basis as being fundamentally fair not only to the states but to the corporate entities doing business in those states. And it either apportions or it allocates income based upon a admittedly fairly complex set of rules as to how that income is divvied up. But the focus is to find a portion of income that fairly relates to the business taking place in each jurisdiction, and to allow that portion to be taxed, to be the tax base in that jurisdiction. As far as uniformity goes, MTC has always been a proponent of uniformity. That was one of our basic concepts as we began our journey along with cost in the late 60s. We found that uniformity is an extremely difficult thing to deal with, primarily because of one big reason. Nobody seems to be very interested in uniformity today, neither states nor businesses. During my 8 years in the Commissioner's office in the state of Tennessee, I will tell you that of all the business entities that came and sat down with me and talked about their business operation in Tennessee, not one ever asked me to be treated just like everybody else. Not one. So uniformity, at least from my view of the business perspective, is not something that businesses are really that much interested in. And I want to be quick to say it apparently is not something the states are very interested in either. As you look at the world of credits and incentives, of tax competition that we're going to touch on later on, we see an environment where the states are certainly prepared to slice and dice their own tax bases for benefits perceived. So everybody seems to go their own way and do their own deal. Uniformity is something that's still near and dear to my heart. I see very positive aspects for it, both at the state and the international level. But the practicality of reaching some kind of uniform base kind of flies in the face of what we see out there every day.
I have a follow-up question for Diane, but I thought we had a question on this side of the table.
Yeah. Valerie Dickerson, Deloitte. I'm curious what your reaction is when you were called upon to advise around maybe a type of model for allocating on an international basis. What do you say in the face of differing interpretations of the rules? And we'll go into the sales factor. We're talking about this goes to the base, and I think that single sales factor and then market sourcing for services puts a lot of pressure around the nexus question and what the tax base is. And then kind of layer onto that the states that judicially have gone to a term of apportionment, so they have maybe a performance-based factor allocation on the books, but in controversy they'll go the other way. What would your counsel be to? Would it be the MTZ model, or watch out, or what's the counsel there?
Well, what I would say is that the MTC has proposed for a number of years what we believe to be a fair and concise method of determining that, and it's called factor presence. And we look at the factors of payroll, property, and sales. If you have any of those above a certain level, and there's nothing sacrosanct about the numbers, it's the structure here, then you have nexus in those jurisdictions for tax. What we tell people when they talk about the complexities here, either at the state level or at the international level, is that tax is a complicated world. And it's critically important that jurisdictions are very quick in developing and promulgating rules. The rules are certainly as complicated in dealing with permanent establishment or in the EU as they are in the states. And it's my belief that no matter what methodology we have going forward, it's not going to make it less complex. So it's critically important that the jurisdictions involved have a transparent and rapid method of promulgating and establishing rules for any of these issues.
And Valerie and Joe bring up some very good points. So Diane, can you just tell us and provide your thoughts on what you think the strengths and weaknesses are of formulary apportionment? I mean, what works, what doesn't, what the problems are?
Sure, and I think when we talk about the strengths and weaknesses, some people, it'll be a strength, and the exact same thing to someone else will be a weakness. So I will talk a little bit about here kind of where some of the pressure points are. One of the, I think, biggest problems that we see right now with the formulary apportionment as the way it's been implemented by the states is that we seem to be using an economic model that's several decades old to try to apportion the current income. And when I say that, it's things like when you look at the property factor, for the vast majority of states, the property factor only includes real property and tangible property. It doesn't include intangible property unless you're a special industry like financial services. And we can see, over the past many years, intangible property like trademarks has become much more important, yet it's not included in the property factor. So some of those changes in the way the economy has happened have not been really pushed through to the way the apportionment formula is calculated. Another problem that comes up, and I kind of think this is the perfect storm, is, as Joe said, many of the states are working toward getting a single sales factor. The reason for that, and this is a problem that's inherent in an apportionment formula that includes factors of production like people and property, that whenever people and property are in the apportionment formula, that means that additional investment in a state is going to increase the numerator for the taxpayer and thus increase their tax. So there's going to be a pressure on the states to try to take out the disincentive to invest in the state. That's why we're moving toward this single sales factor concept. At the same time, the states are also moving toward the economic presence nexus. So states that have a single sales factor and economic nexus, you've got taxpayers that have nothing in the state, no property, no people. They're not using the infrastructure of the state the same way that companies that are actually there are. And yet, if their sales are equal, then they're going to have the exact same apportionment percentage. And that's another pressure that I think is going to be coming up in the nexus arena and coupled with the problems with the apportionment formula. Another issue that I think is increasing in sensitivity is some of the definitional problems that can create a very real risk of double taxation, and for the state's perspective, also a risk that the income isn't going to be taxed anywhere. And so when we look at, historically, I think as was talked about earlier, there was always this cost of performance standard if you were selling something other than tangible personal property, like services or intangible property. This cost of performance standard. Well, states are now pretty drastically moving away from that to a market standard. The problem is that the definition of market is nowhere near equal among the states. The MTC has worked very hard at creating some type of definition, but you know, this is an iterative process, and many states have already come up with very different definitions. So even though they'll say we're a market state, that's not the end of the story. You have to very carefully look behind. Okay, do they have regulations? Are they saying it's, you know, for services is where the benefit's received, it's where the services are delivered? Those could be two very different concepts. And I think that's something that we're going to see going forward is going to be a real problem when we're trying to, you know, enforce the apportionment formulas.
Oh, I'm sorry. Yep, Peter.
Yeah, going back to Joe's comment about the breakdown in uniformity of factors and looking at what can the international community maybe learn from the state experience. So, I mean, it would seem to me that producer countries may have an incentive to weight towards property and people, consumer nations incentive to weight towards sales. And this would inevitably lead to double taxation. Going back to Peter Barnes's one pie concept, how do we avoid the double tax problem?
Yeah, can I just speak to a couple of those issues? One is that I agree with Diane. This is in the sense that we live in a fundamentally different world in the 21st century than we did in the 19th century when physical presence and PE standards found their home. We live in a consumption-based world, certainly in the U.S., and producer nations, quite contrary to what Peter suggests, producer nations have a pretty strong political incentive to go to a single sales factor because it reduces the tax burden on their localized industry if sales are worldwide. I guess what I would say to you is that, yes, there are some complexities, there are some details that certainly have to evolve over time as we look to an intangible kinds of commercial base across the world. But that speaks to the fact that physical presence can no longer be a reasonable standard in the world that we live in. That's not how people do business. And the states and nations are going to have to adjust their mechanisms for taxing business entities that do business in their jurisdiction. And the fact that you have property tax base or not doesn't drive the fact that it's almost impossible to do business in a jurisdiction without the ability to enforce your contracts, without a requirement upon the government to be able to protect the structure that you have adopted. So it's not without It's not without requirements of the government that people do business. They do business all over the world. They can be located wherever they want to do business, and the fact is that governments are going to have to adjust to the 21st century, not the 19th century, in how they build their tax bases.
We have a question in the audience right there.
Thank you, David. Scott Dranker to the Tax Foundation. There seems to be a lot of talk about how to, well, this might be coming from Joe mostly, talk of how to get at a tax base or how to make sure that people are paying based on activity, et cetera. How does the benefit principle enter into the conversation here? Because eventually we have to realize that, especially for corporate taxes, these things are going towards infrastructure costs, and that really only benefits people in a geographical area. So sourcing that moves away from a geographical basis to tax people seems a little bit out of place. How do we enter the benefit principle into the conversation, and what is its place?
Yeah, I guess my focus would be, as I said before, the structure of the benefit received is a discussion that really does come out of a period where everything was, you had a local business inside a corporate jurisdiction and you got fire and police protection. And everybody said, oh, you got fire and police protection, so you got to find some way to pay for it. Well, in the modern economy, that's not the only thing you get. In fact, what you get is a marketplace that's secure, and that your contracts and your ability to carry on business and enforce those contracts and have customers is protected and guaranteed and maintained by a local jurisdiction. So, yeah, it's certainly an argument we've heard over time. I'm not sure that the benefit received argument is as forceful as it was 75 years ago, but it's certainly an argument that takes place. And if the calculation is going to be, oh, I get very little, so I shouldn't have to pay anything, that kind of rolls back to every single tax base out there. I've passed the point that my children are in public schools, so I get no benefit from public schools whatsoever. And boy, would I like to stop paying property taxes. But that's not the world we live in.
Good point.
Can I pull us back a minute?
Yeah, sure.
It's great to hear these state tax discussions because they bear closely on the international side. But I feel like this was a mile-long race, and we immediately jumped to the three-quarter point, which was, how are we going to look at the factors and split this stuff up? Let me go back just a minute. There's an interesting discussion buried in Kimberly Clausing's piece in here, and I recommend it to you very highly. From an international perspective, we quickly, in this debate, and it's smart people, it's Kimberly Clausing, it's Lee Shepard, it's Mike Durst, we immediately set out two paradigms. At one paradigm is the separate entity arm's length side. At the other end is global formulary apportionment. And we talk as if those are the two models, and by God, separate entity accounting, arm's length standard is completely broken, so let's go grab this global apportionment. I don't think that's the way the world is going to work in any realistic setting, but I also don't think that the apportionment approach, formulary apportionment approach, is silly. Let me try to put it in context. Separate entity accounting, and I'll get to it in just a moment, I think is absolutely the way to go. It is the only way to go. We're going to go that way. The UN has looked at it. The OECD has looked at it. I think we're going to stick it with separate entity accounting. But, within the transfer pricing methods, there are a variety of accepted approaches: comparable uncontrolled price, cost plus, resale minus, profit split. In appropriate cases, and there are not a lot of them, but there are some. In appropriate cases, profit split is a reasonable way to allocate income at arm's length in a separate entity accounting world. And we've got plenty of examples of that. The best one, the easiest one to get our arms around are the advanced pricing agreements for global dealing. The global trading agreements between the US, the UK, and Japan are well developed. It's essentially a profit split. They're pieces of it, unitary formula. So I don't think we have, realistically, if we want to talk about what's realistic here, I don't think we have a world in which it's either separate entity accounting, arm's length test here, or formulary apportionment over here. I think the real dialogue needs to be, within separate entity accounting, are there places where formulary apportionment of some manner is appropriate and is helpful? Now, let me just very quickly say why I don't think you're going to get global formulary apportionment. The biggest tax issue in the international arena today is India's insistence that companies in India earn profits substantially higher than they earn elsewhere in the world. And India has economic data to suggest that's true. Counter to that, Japan economic data suggests Japan companies earn less than most companies earn on a global basis. It is inconceivable to me and not appropriate, in my view, to look India in the eye and to look Japan in the eye and say, whatever factors you are, I don't care what factors we come up with, whatever the factors are, you're going to earn the same profit level per factor in two countries where you demonstrably have different levels of profits. It's one thing to do that within the states, but I don't think between California, New York, Florida, Texas, Montana, Tennessee, you have profit levels as dramatically different as you do between Japan and India. And so we can talk about formulary apportionment within the states. In the international context, there's some utility, but the utility is to say, as one of the transfer pricing methods for separate entity accounting, let's keep formulary apportionment in appropriate cases like global dealing. So anyway, I think factors are important. I don't mean to pull us back from factors, but factors is getting down to the red zone in the game, and I think there's an awful lot of the field before we get there that's important.
So, Peter, formulary apportionment is not the be-all, end-all solution in the international taxation area.
It's not, but within the separate entity accounting arm's length standard, there can be situations where profit split, and profit split would encompass formulary apportionment in appropriate ways, can be an appropriate way for allocating income under an arm's length separate entity accounting approach.
Okay.
Marty Lobel. The problem with formulary apportionment, every IRS commissioner who's ever testified before Congress has said they cannot police it. The advanced pricing agreements are now all secret, courtesy of legislation that exempted them from Freedom of Information Act. So we're trusting the Treasury and the IRS to do the right thing without any supervision. Formulary apportionment takes into consideration the increasingly growing value of intangibles. I mean, the fact that the Cayman Islands is now the 5th leading banking center in the world really belays credibility. What we have to do, at least in my view, is go back to some sort of a formulary apportionment that will take into consideration the problems that you've mentioned and get away from unitary because it does, get away from transfer pricing because it doesn't reflect real values when royalties and intangibles are increasingly valuable and located in Isle of Man, a solicitor's desk in Ireland. That's what Microsoft did and saved $300 million in taxes, according to the Wall Street Journal. I mean, this is getting worse and worse, and even BEPS has really given serious consideration, if you read international tax notes, to formulary apportionment modified to take it into consideration the various producer versus consuming countries. So what I'm hearing now is the usual arguments industry makes, tax him behind the tree, but not me, and they've learned how to take advantage of the international loopholes, and Treasury, so far as I'm concerned, has done nothing but aid them.
Well, I may not have been clear, but I think we violently agree.
I'd be pleased to hear that.
I think there's, I'm not saying there's no problem. Absolutely, we have issues we have to concern. The question is, do we throw out separate entity accounting? And to me, I just don't see a system in which on an international basis, getting away from separate entity accounting is going to get us very far. India and I don't blame India. India has economic data to support its arguments. India will say, your company here makes profit levels of 20%, 30% higher. I'm not going to take your global profit level of 10%. That doesn't work for me. So I think the question is at a narrower level, not at the separate entity accounting versus global apportionment level, but at a narrower level, do you have integrated operations where some sort of profit split, formulary apportionment to deal with residuals may be appropriate? But that is very, very different from the notional idea that we're just going to throw the company all together and then split up its profits around the world. And that, I think, I'm caricaturing it, but that is the notion that formulary apportionment says. It says, I can't deal with any of this stuff, throw it in a pot, split it up. I just don't see that happening because profit levels are demonstrably different around the world.
Yeah, let me briefly speak to that. The concept that I often hear is one which Peter espoused, and right up until he said only way to go, I was really agreeing with him on a lot of the things he had to say. But I want to point out to you that combined reporting has been operating in the United States since the 1930s. And has become more and more embraced by many states. Maybe more than half the states have some form of combination right now. It does, in fact, work. And if you look at the flow of what goes on in the U.S. as opposed to looking at a global entity structure, we really are a bottom-up kind of structure, so that the states operate kind of as a separate entities, as you will, sovereign states in their tax structures. And much the same way that many of the countries around the world do in their relationships to each other. So I don't want to say that there's not problems with combination. There certainly are, and I recognize those that Peter outlined as being problems. But they're problems that the states have been facing now for decades, and they have built rules and a basis for dealing in combination and in unitary business principles that do, in fact, work. Now, we live in an environment in the states where we have separate entity reporting states and we have combination states. The implication is that somehow you have to have this great world bubble that enforces combination on everyone. That's simply not the case. It's never been the case in the United States, and I'll say to you that it wouldn't be the case in the rest of the world. And as India and Brazil and other countries out in the BRIC group have indicated, they're perfectly prepared to go their own way with their own structures that are meaningful to them. And each individual country out there could begin to adopt some type of apportionment regime, because I'm not here saying, gosh, we've got to walk away from arm's length pricing tomorrow. I'm not. I'm just saying the same thing that you're saying, except I'm reversing it. I don't think that the concepts of arm's length pricing have a very long future in the world of tax either.
We had another question right here.
Eric Toder, Tax Policy Center. I actually want to ask two quick ones, following up on two comments by members of the panel earlier. One, Joe referred to tax competition, and I understand tax competition among the states really has to do with attracting business or industry to your state. In the international world, there seems to be another form of tax competition which countries seem to feel important, and that is getting companies to be resident in your country, supporting your national champions, which may or may not have anything to do with the amount of domestic investment. And I just referring to the recent Medtronic merger, where they've gone to Ireland, but apparently nothing is happening to their activities in Minnesota or anything like that. So, so that's one question about in looking at the state international. Is the different forms of competition meaningful? The other question I wanted to follow up was Diane's comment about the formulas not taking into account intangible property. And so I just wanted to know if anybody thought, if you did have a formula, how would you allocate intangible property?
you want me to start with that question? Sure. Okay, sure. And it's a great question, because since the very concept of intangible property means that you can't actually find it anywhere. But I think that you can look at different types of property, and for example, patents. You might decide, well, the patents should be sourced based on where they're being used. So is there a manufacturing plant that's using them? Is there a research facility that's using them? Are there several manufacturing plants? Trademarks, you might look at where they're being used. You might look at the area that they're being developed in, where they're being enforced. So I think that there are situational examples that you can use to source that intangible property that would be more reflective of actually how the company's value is being generated.
Yeah, let me respond to Joe's point, and Joe's points are well taken. The question is whether you're a glass half full or glass half empty kind of guy. You make a very important point, Joe, which is that, yeah, the states, we've lived with the fact that some are combined reporting, some are separate entity reporting, and we don't have to have uniformity, and I agree with that completely. And in the international setting, we're not going to get complete uniformity. I get that. I would point out, though, that the states have tax rates generally running from 0 to 10. In the international world, it's from 0 to 40. So the stakes are a lot higher. In the states, there's a heck of a lot of commonality. We're one country, and there are only 50. In the international world, there are 200, and a lot less cohesion. So I don't pretend that we're ever going to have a global system that works right for everyone. It's important to remember Brazil has gone its own way. Brazil has said, we are going to have stated profit I'm being very simplistic. We're going to have stated profit margins. You want to do business here, you're going to show this margin whether you do or don't. That's that. So you can have a variety of countries go with separate entity and combined reporting, and we'll learn to live with it. But boy, talk about complexity. If on a going forward basis, you have combined reporting in France, you have combined reporting in Germany, but it's a different unitary group. If you have combined reporting in Japan, but it's a third combined group, and then 6 other countries that have separate entity reporting, somebody's got to look taxpayers in the eye and say, yep, you're tripling your compliance team because we can't get our act together as tax administrators.
Peter and Diane and Joe actually raised a bunch of terrific issues, and the one that strikes me is that the state corporate income tax, long considered a sieve, right? It is not very robust. It is not very strong, despite Joe's efforts and the FTA's efforts and the Revenue Department's efforts and a lot of good college tries. The state corporate income tax is always under siege. Increasingly on the international side, and if you read Tax Notes and Tax Notes International, you'll see this every week, every day, that the international corporate income tax regimes, because of aggressive planning and interjurisdictional competition, et cetera, are under siege. And so the question is, can anything be done? I mean, what is the solution to two tax structures that are widely considered less than robust?
I think it's a menu. I don't think there is a panacea. I don't think there's a specific issue. I think there's probably more transaction taxes. We sit here talking about the importance of the market countries, and I get that. That is crucially important in Joe's comments, that what do you get if you have no physical presence, but you sell there where you get a market? That's important. I think you recognize that not through income taxes, but through transaction taxes of one type or another. The U.S., we all know this backwards and forwards, the U.S. does not have a VAT. And therefore, any comparison of how our corporate income tax compares to other countries' income taxes is apples and oranges, because in the other jurisdictions, they have a VAT. So one solution, a part solution, is a VAT. I think you go with simplified methods and safe harbors. If we think transfer pricing is so hard, and it is, we can pick simplified methods and safe harbors. The taxpayers will jump on that. That's the discussion that's going on now between the U.S. and India. Has not reached a conclusion, but that would take a lot of issues off the table. And then enforcement. Sam Maruca of the IRS cry for help. And what happens? The budget got cut earlier this week by $300 million. Proper enforcement so that you're picking your cases, you're making sure the buy-ins are the right value, that sort of thing. I think there's no single solution, but I think there's a menu of solutions that can make a real difference.
Yeah, I agree that I think there's a menu of solutions out there also. I think from the other perspective on some of these issues having to do with value-added tax, for instance, I think I would go back to what I mentioned earlier before. I think it's important to keep in mind that the U.S. structure really is a bottom-up structure. Most of the countries with VATs around the world are top-down structures that largely had these value-added structures given to them after World War II, with the exception, of course, of Switzerland. And that the complexity and the problems of replacing, and of course you first have to start with the question of if you're talking about a VAT, are you talking about an add-on or a replacement? And with either one of those, the complexity of either adding on or replacing in a bottom-up system that has broad reliance, tremendous reliance out across the states in a sales tax base to either lay on the top of that or to replace that with a national value-added tax, albeit having local functions, would be stunningly complicated.
Yeah, let me touch one other thing. There's been a hint in the first hour, and not explicit, usually it's explicit, but maybe we had a hint of it, of sort of morality, that these amoral corporations are doing a host of things that are bad, either aggressive tax planning, or other things that are bad. I'm perfectly willing to accept we need to have that discussion with respect to corporate taxpayers, but there's a hypocrisy here that drives me nuts. Joe touched on it, and he pointed out he no longer has kids in the school system. He'd love to not pay the property tax. But let me just mention three quick ones. And tell me, you don't have to raise your hands, tell me if anyone you know has done any of these things. They earned deferred comp in a high tax jurisdiction like Washington, D.C. or New York, and they moved to Florida and received the deferred comp with no state tax. They spent their work career, that's one, spent their work career in a high tax jurisdiction that had an estate tax. They retired to Florida where there was no estate tax. Third, they managed their days in and days out of New York City so that they would avoid the New York City tax. If you pick up Kiplinger's magazine, if you pick up Money magazine, if you go talk to any personal advisor, these are pure vanilla, simplistic tax planning things, and there's not the slightest moral taint to any of it. And yet everything we're talking about here with respect to corporations is exactly this. It's deferring income one place, receiving it at another place. It's measuring your days in, measuring your days out. If we're going to have this sort of moral taint about corporations, and I'm not saying we shouldn't, let's have that discussion, we've got to be willing to look at our neighbor who does these things and look at ourselves who does these things and say, is there a difference? Is there a moral difference between the individual who does this and the corporation who does this?
We had Harley and then Joanne, or...
I think it was in the other order.
Oh, I'm sorry, Joanne and then Harley.
Thanks. I probably have one of these microphones. Well, I just have, I guess, 3 points that came to mind. The first is, Peter, you're talking about India having a 20% profit margin, how outrageous that is. I think Marty Sullivan at the end might raise the 200% profit margins in some of these tax havens as being a problem. Back in the 1990s, the Treasury Department had a conference. Eric Toder was at Treasury, and so was I at the time, where we looked at all these issues. I feel like nothing has moved in the last 20 years in terms of looking at these issues about formulary versus arm's length for the U.S. However, there's been tremendous movement in one area where I think actually people can learn a lot, and that's in the European Union. Back in about 1990, the Rudin Report came out. They totally rejected formulary. 1994, US, OECD, new transfer pricing, firmly arm's length. Well, guess what? In 2011, the European Union proposed, not just talked about, not just issued a report, but actually proposed formulary apportionment among the EU member states. Now here's a catch there, and Joe worked on some of this, and I worked on the report as well. The catch is that it's not mandatory. Companies can choose to stick with separate entity if they would like, but if companies feel like this spaghetti method of connecting points just doesn't work, that the compliance costs are so high, they can go to a simple formula and use that to determine their income within the EU. They also learned a big lesson from the US states that said, none of this unitary tax stuff, and no worldwide taxation. So it's water's edge, and it's an entity basis, not a combined report. Okay? So those are the 3 points I wanted to make about that.
Thank you, Joanne.
Harley?
Thanks, David. Harley Duncan with KPMG, and I want to, I guess, I understand the motivation, Joe, having defended states for 25 years, but I think you let them off too easily on the uniformity question. It seems to me that it really is wanting your cake and eating it too when you argue for economic nexus, 100% apportionability, and then say, oh, but after that, we'll do whatever we want. And I'm not sure we need to get down to the level of benefits received versus services delivered and die in that quagmire, but instead I think it's like Peter says, there's a lot of halfway steps of whether it's elections, safe harbors, and the like that can be done to create greater consistency across the states, which seems to me to be necessary, or at least a concomitant of 100% apportionability and nexus everywhere, and still deal with the compliance issues. Because that, I think, is a real burden that is coming down on the U.S. state corporate income tax system. Second, I'd echo what Joanne indicated. Well, I think part of the subtitle here was Lessons for International Reform from the States. I think there's plenty of lessons we can still take here in terms of what, for example, they're doing in the European Union on indirect taxes for compliance burdens, for consistency in rules. And then the other thing about consumption taxes, and this is just the extraneous, worthless comment, but if we continue down our path of single sales factor, this and that, we will have a consumption tax that is broadly based, albeit poorly designed, at the state level, because that's all we're taxing is consumption in the state of some consumption of our choosing from some taxpayers of our choosing. Not very well designed, but that's where we end up.
Diane?
One other thing on the state level is that also it's not transfer pricing versus apportionment at the state level, because the states also use a transfer pricing regime to decide in many cases what the overall tax base is that is going to be then apportioned among the states. We've got quite a few states that have historically looked at the whether there's arm's length pricing between the affiliated entities to adjust the actual tax base. Any sort of effects on changes at the federal level on transfer pricing concepts have a significant effect on the states that use that transfer pricing concept.
Yeah, let me address that. I agree with Diane. A lot of states do that, particularly the separate entity states, and they, where they can, they look at those things. But as I mentioned before, they're heavily reliant on federal taxable income and their ability to actually go above the line and look at those numbers and make some calculation as to arm's length pricing is very difficult for any state, and most states simply don't do it. They start with where they are at federal taxable income, and that's where they stay. As to what Harley had to say is letting the states off too light. If I did, I didn't mean to. The states are as complicit in this as anyone else in terms of their inability to reach or to dramatically drive toward more uniform processes. But what I would suggest to you is that the states are merely the handmaidens of the political process. The political process is largely driven by private industry throughout the country, and I would say to you that where there are any MTC uniformity proposals, if industry would join hands with me, I would go around the country to each of the legislatures and ask them to enact these uniform rules. Industry has no interest in doing that, and they're not going to. They'd a lot rather see states preempted by the federal government to achieve uniformity. They repeatedly focus on a national structure as opposed to a state sovereign structure. I understand that, and toward Peter's point, I don't see any of these things as a morality play. Businesses do what they do because it's in their best interest. It's in the best interest of their shareholders, and they're the people who receive dividends from the Fortune 5000. They expect their companies to pursue these avenues to reduce their costs, to increase their dividends. That's the way of the world. I've got no problem with that. It's not immoral to make a profit.
Yeah,
But I would suggest to you that my final point is that as I have often been known to say,
Doug, all right.
you don't always get what you pay for.
There's no doubt that Doug would.
Yeah, Doug's ready to go. You don't always get what you pay for, but you do always pay for what you get. And that proposition leads to taxation generally, and the question is the structure we have fair? Not moral or immoral, but is it fair?
You know, Joe and I have this conversation a great deal, at least 10 times a year. And let me sort of back up a little bit and talk about the notion, does business want uniformity? And why hasn't uniformity worked? Well, what has not worked is voluntary uniformity. And I understand it's pressures, it's political pressures driven both by business and by state interests. Business is not monolithic. So naturally, when a business comes into Joe and asks him for favors, they're going to look after their own interests. But everybody here at the table sort of inherently realizes that uniformity is good. But we also realize the dichotomy of individual interests versus what's good for the business community as a whole, right? So how do we get past that dichotomy? We're not going to preempt state structures by going to the federal government. But there are, and this is sort of backs up Harley's point, there are sort of situational areas where I think we should go to the federal government and impose uniformity on the states, impose thresholds, impose administrative uniformity that would tremendously ease the compliance burden and ease the ability of our business community to compete on a global basis. 3 areas that I consistently talk about. 1, thresholds. We have the most advanced economy in the world. A company still doesn't know how much of a presence that they will have in a state before they have a jurisdiction to tax. We don't know the answer to that. Second, administrative convenience. Why not? And I kudos to the streamlined sales tax effort, but again, that's a voluntary effort that really has stagnated. You know, it really, and the third is areas like, you know, thresholds like the mobile workforce bill. When you travel as a state employee, why should you be subject to 50 different sets of rules from state to state, half of which, you know, most employees have no idea? Why not impose a single threshold before state rules kick in? It just makes common sense to me. And it's not that, you know, the business community wants to preempt state efforts. I think there is a happy medium between areas where federal uniformity can be imposed on the states but not take away their sovereignty. And that's what we're looking for. And Joe, I'm happy to walk arm in arm with you through the halls of Congress to try and get there.
We have, our Twitter feed is buzzing. I don't know if the Twitter feed's buzzed or not.
Twitter buzz? I don't know.
But we're getting lots of social media questions. I wanted to pose a couple of them to our panelists. And this one I think would be for Joe and Diane, or anybody else up here who might know the answer. Is there any data, or do you have any sense of how much money states lose from offshore tax planning by multinationals. So that seems pretty straightforward question. Joe, do you have any idea?
You know, all I know is what I read in the paper, and so there's some question as to the validity of that kind of thing. But you know, I've certainly, and all of you have seen numbers ranging from as low as $1.7 trillion offshore to, and this is raw dollars, not taxable income, but 1.7 trillion to 20 trillion. So the answer to your question from the perspective that I look at is I haven't got a clue. It's big.
It's
Number's
big.
big.
It's big. Well, except that's apples and oranges. I mean, to say that because income is earned offshore and is kept offshore, you've somehow, you know, reduced your state taxes, that's the tail wagging the dog here.
Well, I might argue with you where that income was earned.
Yeah, I'm just saying, it's an interesting question. It's a hard question, but I'm not sure there's any data for it. And I know 1.7 offshore, we can argue whether that should be offshore or not offshore, but that's not offshore to deny states their taxes. That's the 35% U.S. tax, not the 4% state tax driving that decision.
So a follow-up question that certainly some of the practitioners on the panel or up here might know the answer to is, do state tax considerations play into tax planning for multinationals? So if you're advising multinational corporations in terms of their international tax structures, are you thinking about state taxes?
And I would say it affects them two ways. Number one, multinationals, I guess by definition in this case, are doing business in the U.S. to some extent. And so that, yes, they are going to be looking at tax considerations. Is it going to trump decisions on their federal tax issues? Probably not, because of the difference in the rates. But on the margins, they're still going to be considering the state tax issues. Then also, when you look at the multinational arena, where we've got tax issues that really come into play is if you have someone who's done some type of tax arrangement in the international arena, you want to make sure you're not making things worse in the state tax arena for that taxpayer. So those are two examples.
Yeah, and I think those are all good points, and I think Peter is right. You know, the trickle-down proposition that if there's a couple of $1 trillion being held offshore in repatriatable, if that's a word, dollars, you know, the first stop of that obviously is federal taxable income. So, you know, the states are only taking a few billion-dollar hit instead of the really big money, which the federal government is having to forego. But what I would suggest to you is that, you know, just as a matter of curiosity, I'd love to know which of those Fortune 1000 worldwide companies are actually paying 35% or even 15%.
I'm going to indulge myself here because tax is one of my favorite things. I know what tax avoidance is. I know what tax evasion is. I think I know what morality is. I was raised by the Jesuits. But what I can't figure out is tax and morality in the same sentence? I'm sorry, it leaves me scratching my head. Peter, you said about the issue of taxes and morality, which I first confronted in Europe, that it fits into the debate. I'm curious how, because this really is a problem for me.
Today's discussion has actually had, I would say, less of the morality tone than most.
Yeah.
But today has had that, you know, that atmosphere about it as well. And I get it. We would not be having this discussion at all if everyone believed that arm's length pricing and separate entity accounting worked. Period.
Good point.
We wouldn't have this meeting. We'd all be home. The only reason we're here is because of a perception that taxpayers push the envelope. Maybe it's legal, but it shouldn't be. You know, maybe it's illegal. Maybe it's illegal and the government doesn't have the tools to find it. But the only reason we're here is a perception that somehow fair payments of taxes to jurisdictions are not occurring. So yes, there's a morality, and I want to have that debate. That's a fun debate. That's an important debate. The point I wanted to make was we somehow have blinders on. And when it's an individual who earns deferred comp in one jurisdiction and takes it in another jurisdiction.
That's tax planning.
It's tax planning, and it is pure vanilla. That is why why Money Magazine exists. And we would not even say to our neighbor, oh, why are you moving out of the school district now that your son's a senior in high school? We don't even think about that. And yet in the international tax arena, we have this, it may be legal, but gosh, it shouldn't be, as a cloud over the whole discussion. So I think morality is important. I think the morality discussion ought to occur. I think it ought to occur with respect to both corporations and individuals, or somebody needs to explain why the deferred comp example for individuals is just fine and the counterparts for corporations are somehow not fine.
Yeah, and I have some advice. If you don't want to get in trouble at a cocktail party where people are talking about taking advantage of the charitable deduction, don't say you admire GE's tax planning. They throw stuff at you.
GE is audited around the world.
Around the clock.
All the time. 25 agents wake up every morning and go to the office and audit.
Right. Eric?
Hi, I'm sorry, I just can't let this go.
Neither can I.
First of all, I don't think it's a difference between individuals and corporations. I don't think anybody objects if corporations use bonus depreciation to reduce their tax liability. That's an incentive that Congress deliberately put in the law for the purpose of stimulating investments. We may think it's good or bad policy, but there's no ethical issue there. I don't think there's any ethical issue if I put money in a 401k. I mean, I am avoiding tax because I could make the same investments outside the 401k and pay more. I do think there's a question when people engage in transactions, and it's very hard to know where to draw the line, but I think we would not have a civilized society if every action by every human being, that all we did was obey the law and we showed no consideration for other human beings other than obeying the law. I think we have to really ask the question about when we push the envelope, what is too far and what is not too far in terms of, and I think it has to do really in some sense with what the law is intended to do. When you do something that's different than what the law is intended to do, it may actually technically be legal, and it applies to individuals as well as corporations.
Yeah, and
but
Eric,
I do think those issues need to be engaged. I don't think it can be dismissed by saying that any response to incentives by a company, if they invest in a country which has a lower tax rate, that's fine. But the other aggressive tax planning, I think there are some issues, and I don't know where to draw the line.
Peter, excuse me one second. Eric, that's an interesting point. You hear the morality discussion, and Chris and I we've been talking about it at Tax Analysts for a long time. You hear the morality discussion mostly on the international front, right? It started in the UK and Starbucks and all that, the Prime Minister and so on and so forth. You don't hear it much. And I wanted to ask our state panelists if they hear it. You don't really hear the morality issue of taxes morality at the state tax level all that much. Would you? I don't know if you would agree with that, Joe or Diane.
No, I disagree, and I think that a couple things come in. The first one is that there's been a lot of work from a professor out of Alabama that has used her religious views as sort of a concept for morality, and she's written a lot on how that should inform state governments and how. So that's sort of one area that we've seen, and I think other people have taken her up on that on similar areas. But certainly in the corporate arena, there have been, and I don't know if it's been formally written about, but a lot of discussions about corporations are bad because they set up their intangible holding companies in Delaware. And I think that when you read some of the cases that have determined, for example, that nexus existed, kind of one of the underlying themes is that there was something bad Not legally necessarily, they found a legal reason for it, but that there was something inherently bad about doing that, and that's how the court got sort of justified. So I think that there is this definite underlying current of morality. Joe?
Well, I guess there is. I guess there is too, and some level. I guess I personally have a problem with the concept that an artificial legal structure is somehow can be immoral. From my own perspective, that kind of falls into the area of who people are. I go back to the concept of fundamental fairness as to questions that we can disagree on. The issue of morality or immorality is one that we can obviously agree or disagree on, but it comes at a completely different level.
It's Jamie Yesno, it's Grant Thornton. It's the classic question of what one can do versus what one should do. And I know that I, as a practitioner, I wrestle with that question every day in the state tax arena. I guess the question for Diane, I'm going to tie it back to what we talked about earlier. When you have a client that is in the multinational, has very little presence in the U.S., but all of a sudden determine that there's nexus, even though you might not have permanent establishment, what do you tell that client? Do you tell that client, well, the states aren't going to catch you? Or do you say, well, these are the legal requirements, this is what you have to follow?
Oh, it's definitely the latter.
Well,
California is out there. I'm never going to tell them the states are never going to catch them, because I do think that there are some very sophisticated states that are being very careful. And then I don't think it would be, sort of from a legal, ethical point of view to bring up the issue of you're never going to get caught. And particularly when we're talking about income tax, we do have the FIN 48 issues that the concept of being caught is not even relevant.
Yeah, and in the international area, it's exactly the same thing. I mean, let's face it, you want to file your return, and this goes back to my earlier statement. Whether or not you have nexus is not a big deal. The question is, what's the income attributable? So I would always counsel somebody to say you want to file that return if there's even a close call, because you want to be the one who has books and records and says this is the income attributable to. Because if you don't, and there's later an issue, the government is going to say, well, the income attributable to was 10 times what I think the income attributable to was, and I'm in a hole because I didn't file a return at all. So on a morality basis or a cost-benefit basis, you will always counsel the taxpayer to file the return, figure out the income attributable to, report it, and then be off to the races.
And that's one big difference, I think, between state and international, is that there are certainly states where if you think that the company does not have nexus in the state, it may be a really bad idea to counsel them to file a return in that state, because the state may decide that merely by registering and filing the tax return, that is itself sufficient to create nexus. That's a real dilemma for companies, because they don't have a way then to start the statute of limitations. They may say, we really don't think we have nexus, but we don't want to file because that could be creating nexus. So that's a real issue between them.
Marty Lobel again. I tend to agree with Joe that unlike the Supreme Court, corporations have no persona. They're not real people. They're a collection of people trying to maximize their profits, as they should. The question I would like to raise is, what does this do to domestic companies that have to compete against multinational corporations? And I don't characterize them as foreign or American, because they're all multinationals. When, for example, the last time I looked, GE had a 7% effective tax rate overall, and yet the American taxpayers owe GE a couple $2 billion. I buy GE products.
Let's take GE off the table, because I think it's a red herring. It's a distraction.
Well,
but the issue's important. Let me respond. I think you're exactly right. That's an important point, which is competition between multinational firms and domestic firms. Important issue. I agree with you 100%. But I would simply say we as tax policy, tax professionals, we are always opportunistic in terms of designing our tax policy. We offer an incentive to the new company coming in. We don't offer an incentive to the nice guy who's been running the factory down the street with 100 employees for 20 years. We are always looking at the sort of the marginal investor, the marginal investment. And I think the multinationals, let's be clear, the multinational competing in Illinois with an Illinois company is probably paying the same tax in Illinois for what it's doing. It is if in these intangibles cases that we're all concerned about and legitimately concerned about, the company typically will have rights to the US in the US and rest of world rights somewhere offshore. I don't think, your point's well taken, and it's a legitimate and important issue, domestic competition between domestic only and multinational companies. I don't think there is a big distortion there, because within the US, a multinational is going to be taxed by the states and by the federal government like any other company.
Yeah, but the numbers don't bear you out. I mean, the multinationals pay a much lower tax rate than 35%. I think the effective rate was about 7%. So how does a domestic company who has to pay a much higher tax rate compete against a multinational who doesn't pay as much?
That's
overall?
A blended rate. The multinational's effective tax rate is a blended rate that reflects the taxes paid in the US and the taxes paid outside the US. And so you have apples and oranges for the multinational being compared against apples for the purely domestic company. We don't, I don't believe, we don't have data on the domestic element of the companies and the domestic element of the domestic-only companies. That, I think, is a pretty level playing field.
So we have a question on the right here.
Yes, Charlie Fisher, Deloitte Tax. We were talking earlier about state tax considerations with respect to the international planning, and as was mentioned earlier, you know, we don't see the state driving the international issues because of the difference between the 35% rate and maybe a 4% state effective rate. But what we find is often that it's very important to consider those state tax issues, because for a lot of the things we've talked about today, such as different nexus standards, different definitions of the tax base, how apportionment may come into play, that sometimes that may be overlooked in the international planning with respect to how foreign entities might be subject to tax in the U.S., maybe an unexpected surprise. So it's very important to look through all those issues and advise those companies, as we talked earlier, about those implications. And it's not only in the state income tax area, but also when we look at the state and local level, there's many different taxes to be concerned with that are not based on income, that are not tied into federal tax numbers. And so you got to think about your sales and use taxes, your franchise taxes, gross receipts. And oftentimes those can be much more problematic than the income taxes because of a lot of the conformity. The last thing I'd like to bring up is an area with respect to states actually looking at international transactions independently. So let's take a financing transaction where a U.S. corporation is taking an interest deduction with finance with maybe a foreign affiliate, something that the IRS would have a very vested interest in, and maybe actually already evaluated and sustained it as a valid interest deduction, but us seeing actually a state come in and do an independent analysis and maybe coming to another conclusion. We just saw a case come down in Massachusetts where a deferred subscription arrangement was challenged by the state as not being valid interest. So I'd be interested to hear in the panel about your thoughts about states independently evaluating international transactions.
It's funny, my colleague Steve Kranz and I have had this battle over the past couple days about this very issue. That, let's say, for example, if the federal government comes in and actually audits an issue and decides we're either not going to make some type of change, and in this case we're talking about transfer pricing, that they're not going to make a change, or they actually make a change, and then the company either accepts it or challenges, and it goes through the judicial process. Anyways, there's some type of federal determination on that actual issue. To what extent can the states come in and say, we disagree with the federal government, we think the change should be more, increase in tax? And I think one of the first things you have to look at is exactly what is the state conformity? How do they do the conformity to the federal government? Some states will, basically adopt the Internal Revenue Code. Some states will, there's a few of them that actually say we'll take whatever the federal tax base is. but look at what is that federal conformity and how closely does it bind that state to any federal determination. There are some states like New York that don't specifically say we're following federal at all. You know, they can go their own way. And there, I think whatever the federal government does might be slightly informative, but is not binding on the state. I think some other states, particularly the ones that might have a 482, for example, concept at the state level that completely borrows from federal, they may be bound a little bit more closely to what the federal government has done, as long as the federal government has actually looked at it. Joe?
Yeah, I kind of agree with that in most areas, and that if the states have bound themselves to the 482 rules, they have done just that. But I think the example that you put out really would not so much fall into the transfer pricing, arm's length pricing kind of category, but in a more underlying question, which I think is a serious issue for the states. I think there are any number of transactions that can create deductions from federal taxable income that are found on the M3, like the financing arrangement that you laid out, that I think is a very legitimate and statutory deduction from federal taxable income, but may not be deductible from state apportionable income. And if the states look closely at it, would find a circumstance where many states would want to add that number back.
Did we have a question out here? Right there.
Yeah, well, back there, I'm sorry.
Hi, it's Carl Frieden with the Council on State Taxation. Just a couple comments from a few of the things I heard. I mean, one of the issues being posed is we're looking at the states to see if there's lessons that we can learn from them that we could apply in the international tax arena. And if you look at, really what's happened in income tax, we've had a 60-year experiment now with UDITPA, so the formulary apportionment, at least the basic one that was adopted by, many states over time. And we're clearly seeing, despite, perhaps the valiant efforts for the MTC to make it more uniform at this point, still based on a double-weighted sales factor, the states have voted with their feet, and their feet are, almost half of them now have single sales factor, and in probably 10 more years, 2/3 of them or more will have single sales factor. So they're increasingly moving away from balance factors towards consumption as the only factor, and it's pretty clear why they're doing it. It's one of the same reasons governments are having problems in the international tax arena, which is there's a strong push to always favor your domestic companies, favor them so they can do exports, and favor them so that you tax them less, and that they'll grow jobs in your jurisdiction. And I don't think this applies any differently to the international tax arena, which does then get you back to begging the question of, if you look at, there's two decisions countries make. One is how much they want to tax as a percentage of GMP, and the other one is what is the proportion of the different taxes. And several speakers have mentioned this, but in consumption taxes, Joe's certainly right, we have a difficult subnational consumption tax right now, which doesn't allow for business inputs generally, which makes it very hard, as the states are finding, to build upon. But if you look at it globally, about twice as much is raised by consumption taxes in the rest of the world as is raised in the U.S. So we have a serious problem. Our consumption taxes are at the subnational level. It's a poorly designed system that doesn't have business input exemptions like the VAT has. Doesn't mean we have to move to the VAT, but as we look at how much time we spend on corporate income taxes at the state level, they bring in less than 10% of all the taxes. It does, again, beg the question, should we look more seriously at the balance of consumption and income taxes? If we do, how do we get there?
And you know what, let me follow up on Carl's question, because we had a Twitter question along those lines that just came in from actually a very good friend of the organization. And the question was directed at Joe, but all of you can chime in. And it says, why does Joe think replacing state-level retail sales taxes with a federally harmonized VAT would be so fiendishly complex? If 160 other countries can do it, including, frankly, a lot of little backwards nations, why can't the U.S.? Is he scared of the metric system?
Yeah. Before you go, Joe, I've had this running argument with this great guy for decades. He loves the VAT.
Well, my answer is, one, yes, I'm terrified of the metric system. And the other is that, as I've said now a couple of times, it's a fundamental understanding that we are a bottom-up structure. We have filled the gaps in what we do in our tax structure from the bottom up, from the lowest level possible, from special taxing jurisdictions for alligator control in Louisiana and Florida, to our school districts, all the way up to major components of our general fund revenue in the states. The level at which our sales tax has been structured over the decades that it's been in place, most sales tax started to come online in the 1930s and really caught some momentum in the 40s and the 50s. And by the middle of the 50s, the sales tax were at the apex of where they are. The difficulty in changing that transaction is not the overlay concept that we see in Europe. Yes, Europe and Japan and Asia were able to do this largely because they were scorched earth, for lack of a better phrase, and the World Economic Community at Bretton Woods and other places didn't really deal with these tax structures. But over time, certainly from the period of the Great Depression through the war, these things were largely overlaid. They didn't have this root system that was built up of tax structures that is prevalent in the United States today, that every cubbyhole of need has been addressed by consumption-based taxes in most jurisdictions. And to simply overlay a national VAT to say we're going to do 22%, which would be a replacement level that I've seen, without any regards to the state and local taxes at all, and somehow we're going to compensate the state and local governments, and we're going to pass back to them some revenues equivalent to what they currently raise. Any of you who've ever dealt with a county clerk, let me just promise you that your promise to them of, oh, we'll take care of you, is not going to carry much weight in this country anywhere. So if you don't believe that there's a huge complexity here, let me just reinforce in your mind, there is a staggering level of complexity, not just in tax policy, but in public policy considerations relative to how we pay for what we get.
I'm curious, Peter and Diane, would you agree with that assessment? Because we're trying to learn something. The states may be able to learn something from the international community. 160 countries use it.
I teach a semester-long VAT class at Duke University. I love the VAT. I think it's fabulous. I've studied all sorts of places. Canada's the quickest example where they overlaid and still respected the provincial taxes. I think it's fabulous. I think in my lifetime I will never, ever, ever see a U.S. VAT.
Yeah, and I think, we've got the two options. One is to overlay the VAT on the existing sales tax and keep the sales tax as it is, which would be a sort of instant, incredible increase in consumption taxes for people. And then secondly, we have the replacement where the federal government steps in and then gives it back to the states. The states, I think, have a legitimate question as to whether, over the long term, the government would continue to give them back at the same level to actually replace any type of sales tax. So I do think it's really problematic.
I think they're having this debate right now in India.
Well, they are in India, and Malaysia is the better example.
And it's called tax reform. It's about upsetting those county clerks,
Well,
and making them not do what they want, but do what's better for the tax-paying public.
India is doing it across the 29 states. And Malaysia is doing exactly what Joe described. Malaysia is implementing a VAT and wiping out a whole host of smaller taxes, the alligator tax and all the rest.
Yeah.
So if you want a microcosm, it'll be interesting to see how Malaysia does. I'm optimistic. I think it's a huge positive for Malaysia to get rid of a lot of the alligator taxes and put in a national VAT.
And the comment before Peter came from Marty Sullivan of TaxAnalysts.
Yes.
Okay, well, we'll move on. I'm officially scared of the metric system, too. So let's turn to tax competition. We're running out of time a little bit here. The OECD is drafting a report on that subject, but we also know that the states have for years engaged in the race to the bottom with respect to tax credits and incentives. Anyone who is a dedicated reader of Mr. Benori, and I am one, knows he just loves credits and incentives. So this really should have been your question. but it's really for the whole panel. Can anything be done to address harmful tax competition?
Let me ask whether we all agree on what's harmful tax competition. We may know it when we see it, but let me take Singapore as an example. Many of you have probably been to Singapore. It's a very interesting, terrific country. They have made a policy decision. They have said, I'm not concerned about raising corporate income tax if you bring in 100 very smart, very highly paid people who will buy things and will pay personal income tax. So I will have a 17% stated rate. You can negotiate with me for a lower rate, and that's fine, because my policy decision, my considered, thoughtful policy decision, is that I benefit as a jurisdiction from you bringing in 100 smart people who get high wages and build my economy. Is Singapore engaged in harmful tax competition, or has Singapore made a sovereign decision that it properly can make, may win, may lose, but has made a sovereign decision that's sensible and appropriate? So I know incentives drive us nuts at the state level, they drive us nuts at the international level, but I'm not sure we know what we mean when we say harmful tax competition, because I think Singapore has made a sovereign decision that ought to be respected.
Good point.
Yeah, and I would say that you know, the concept of tax incentives should just play into the overall environment that states have. Not all states have beautiful beaches, warm weather, nice skiing, and so you're not going to tell Colorado you can't advertise your skiing. The same way I think you should allow states to say, we're going to choose how our economic environment is going to be used. It's just part of the pot.
Joanne?
Again, thank you again for inviting me to comment here. Again, back in the 1990s, I worked on the first round of the OECD's Harmful Tax Competition Project. And we had extended debates about, you know, what is harmful tax competition? And when the report came out with that title, it was completely blasted for saying, what do you mean? Tax competition is good. How can it be harmful? And I think we realized that after the negotiations and talking about the kind of stuff, you know it when you see it, what we saw as being harmful was not that countries would have lower tax rates or give incentives and do things that were designed to encourage companies to hire people and to build factories. We saw harmful as being, okay, we'll give a tax break in secret. You come in and talk to the tax authorities, and we'll give you a deal, and we won't tell anyone else about it. Or, for example, they had something called ring fencing. In other words, to name names, Ireland had areas that said, if you come from outside of our area into here, we'll give you a tax break. But if you're a local company, you don't get it. So that was deliberately trying to attract tax base from out of the country inside it. So the harmful nature of it was not that incentives were offered. In fact, the OECD did a very good job at this point in getting rid of those secret deals and getting rid of that ring fencing and saying, okay, go ahead, give your tax breaks, but make them available to everyone. Don't try to steal the tax base. So that's the idea.
Well, and I would commend those of you who have archives of state tax notes, an article, which you can get online, by the way, an article that Harley Duncan wrote, which he may not even remember writing. It was about 22 years ago or so, called The Good, the Bad, and the Ugly, talking about tax incentives. And he said tax competition is a good thing, and tax incentives, broadly speaking, if you're going to compete on taxes, that's a good thing. Industry-specific tax incentives were a bad thing, and company-specific tax incentives were pretty ugly in the big scheme of things. So I think it depends on what kind of tax incentives you're looking at, and what kind of, really what the base of that competition is. Anyway, if you get a chance, you should read that article. It is one of the best things we published. It was a long time ago. It's still one of the best things we published.
And we'll put it up when we get home on TaxAnalysts.com so everybody can get it.
Really a terrific article.
Okay, so just click on the website and it'll be right there.
Do we have time for a few more questions?
I think we got time for two if we're...
Okay, well, here's another Twitter question, or maybe it was from Facebook. Would it be possible for a state to institute a state-level VAT to replace its own state sales tax rather than thinking about a federal VAT? We'll ask Peter, Joe, and Diane can chime in.
I think the answer is absolutely yes. I think it would be extremely challenging because the supply chain doesn't really think about state borders. Our other tax rules don't require you to think about state borders.
Right.
So sure, you could do it, but all the headaches that Joe says would exist on a national level would be magnified if you did it at a state level.
Yeah. I think the states certainly have the capability to look closely at VATs. I think there's a handful of states who have in fact done those kind of things. New Hampshire, Michigan, in kind of a strange way, has spent some time with a VAT structure. There are other states that have looked closely at other types of VAT structures to replace either their corporate income tax structure or in some cases their consumption taxes. So it's something states certainly can look at, and I would say to you, a number of states over the last 15 or 20 years have looked fairly closely at VAT structures. Only a couple have chosen to go down that road.
And Joe, am I right that the states that have used sort of a modified VAT or have even looked at the concept of a VAT, it's usually as the corporate income tax replacement rather than sales tax replacement?
That's my understanding.
Which I think is kind of interesting, not sure why that's the direction it's gone. And Harley?
Where the states have done it, they've done it at the entity level. The New Hampshire business enterprise tax and Michigan single business. Trying to do a transactional tax and get the money in the right place is really difficult among with 50 states. But I would keep my eye on Puerto Rico. First of all, they're going through some tax reform or lots of discussions and looking at consumption taxes, but they're also making some changes to their sales tax that have some VAT characteristics, such as collecting tax on the import, collecting it at each stage, crediting it back, not working with the base as much, but at least using the VAT transactional tax characteristics to improve compliance with their sales tax.
They kind of like the pyramiding structure, don't they?
Well, but there's an opportunity to recapture some of the tax that you pay on the inputs, but it's based on the sales tax base, not a VAT base. So it's just kind of it's a hybrid of hybrids, probably, is what it amounts to.
Anybody have any more questions? I'm very sensitive to people's time. I know you're all busy. So we almost got through all our questions, but we'll end it now. First of all, thank you to the TA staff that put this together, and thank you to all the TA folks who are here or who are watching. The best part of my job is I work with the best people in the world. This has been a fantastic group, including the audience. I want to thank especially our panelists. This was a fascinating discussion. I appreciate you all for coming, and I hope you have a good day.